Progress.
Good afternoon, everyone. A very warm welcome to all of you to yet another enriching session of the Brain Gain Expertise series organized by the Accounting Standards Board of the ICI. We are delighted to have your presence today as we delve into another topic, issues in accounting of property, plant and equipment. This 14th webinar in the series underscores our continued commitment to equipping professions with deeper insights and greater clarity on significant accounting matters. Today's discussion is designed to provide you with practical insights and illustrative examples on the accounting issues related to property, plant and equipment, PPE. The session aims to help you address common challenges in recognition, measurement, and disclosure of PPE, improve the quality of financial reporting, and ensure consistency and compliance with applicable accounting standards in the preparation and presentation of PPE in financial statements. We are privileged to extend a very warm welcome to our esteemed speaker for the day, CA Ankit Gupta ji. Thank you for joining us, sir. Let us allow to briefly introduce our moderator for today's session, CA Karthikeya Kandoi, before we move into the technical session. CA Karthikeya Kandoi is a fellow actuary and a chartered accountant with over a decade of experience in the actuary field, including 8 years of post-qualification experience with a specialization in employee benefits. He is one of the youngest professionals in India to qualify as an actuary at the age of 24 only. His expertise lies in providing a 360-degree solutions for actuarial, accounting, and advisory globally and across industries for employee benefits, including ESOPs. He is also a faculty member for certificate course on Ind AS. With this, I would now request Karthikeya sir to address the webinar and give a brief introduction of our eminent speaker, CA Ankit Gupta. Over to you, sir.
Thank you, Rahul ji. So I welcome CA Ankit Gupta ji to today's webinar. Ankit Gupta ji is a chartered accountant and commerce graduate with over a decade of experience post-qualification. He is having good expertise in the Ind AS field by first earlier working with the Big Four consulting firms by serving various listed organizations on the Ind AS consulting, then in the industry, in the automotive industry, then moving to the Interglobe Indigo, very highly known company in India for last 6+ years as a director of finance. He is quite enthusiastic for the teaching as well. He is encouraging various students, chartered accountants to gearing up in the profession. He is also mentoring various professionals and recognized as a leader committed to the innovation. So over to you, Ankit ji, on the discussion on the challenges in the issues in the accounting of the PPE.
Thank you so much for the warm introduction, Karthikeya. Good morning, everyone. It's been a pleasure to be here with all of you today. Just give me a moment. I'll put on the PPT and then we can start. So I hope my presentation is visible to everyone.
Yes, visible, sir.
So as mentioned, I am Ankit Gupta and I will be taking you through a deep dive into the accounting of property, plant and equipment under Ind AS 16. So PPE is one of the most significant line items in the financial statement, and yet it's often surrounded by the practical challenges from recognition and measurement to depreciation and disclosure. Property, plant and equipment form the backbone of any organization's operations, but accounting for them is far from straightforward. So today we will unravel the complexities of Ind AS 16 through real life scenarios and practical insights. So by the end of this session, you will not only understand the principles, but also know how to apply them confidently in the challenging situations. So with that, let's get started. Here's what we will cover in today's session: purpose and scope of Ind AS 16 and definition and scope of property, plant and equipment, recognition and initial measurement, subsequent measurement including revaluation and depreciation, component accounting, derecognition and disclosure requirements. So let's begin by understanding the core problem this standard is trying to solve. The fundamental problem is many expenditure incurred in one period may benefit the entity in another accounting period or multiple accounting periods. And PP is the question is how to account for the financial performance of that particular financial year. Property, plant and equipment is the best example, a classic example of this problem. India 16 prescribes the accounting treatment of property, plant and equipment so that the users of financial statement can understand information about entities' investment in property, plant and equipment. So when we cover the scope, this standard is applicable to all property, plant and equipment, except there has been certain exclusions which has been provided in the accounting standards. So the first exception is non-current assets held for sale and discontinued operations. A non-current asset held for sale is an asset whose carrying amount will be recovered principally through a sale transaction rather than through the continuing use. These assets are measured at the lower of their carrying amount or their fair value less cost to sale. Please note that this exclusion is part of Ind AS 16 but not applicable on AS 10, as under the AS 10 similar accounting for PP retired from the active use and held for disposal has been provided. The next exception is the biological assets other than bearer plant. So here it is important to understand that what is a biological asset and what is a bearer plant. A bearer plant is a living plant held to produce agricultural produce for more than one period, such as oil and palm trees, or mango trees, or coffee plantation. So they have a very remote likelihood of being sold as an agricultural produce. Whereas on the other hand, a biological asset is any living animal or plant, including a fruit growing on a bearer plant or a harvester crop like corn. So the key difference between biological asset and bearer plant is the purpose. The purpose of a bearer plant is to cultivate the agricultural produce over multiple periods. The plant itself is not the primary output for sales, whereas on the other hand, biological asset is primarily held for sale or for the production of agricultural produce. So a mango tree that produces mango for multiple years is a bearer plant and under the scope of Ind AS 16, whereas the mango grown on such tree is an agricultural produce which is under the scope of Ind AS 41 agriculture. Further, if such mango tree is grown with the intention to sell the wood, then in that case, such mango tree would no longer be a bearer plant, but would be a biological asset and would fall under the purview of Ind AS 41. Other examples of biological assets are wheat or rice plants. With this, let's move to our next exclusion, which is exploration and evaluation assets. Exploration and evaluation assets are the capitalized cost that an entity in an extractive industry such as mining, oil and gas incurs while searching for the mineral resources. These assets represent the expenditure made to explore and assess a specific area to determine if it is technically feasible and commercially viable to extract the mineral resources. Mineral rights and mineral reserves such as oil, natural gas and similar non-generative resources is the last exception. So these are excluded from the scope of Ind AS 16 because their unique characteristics make them fundamentally different from typical property, plant and equipment, and their accounting is instead addressed by specific standards for extractive industries, primarily Ind AS 106. So with this, let's now deep dive into the core concept that what is a PPE. So PPE stands for the property, plant and equipment, and it refers to the tangible assets that are held for use in production or supply of goods or services, or held for rental purposes other than land and building, or held for administrative purposes. So these assets are not held for resale and are expected to be used for more than one accounting period, which means they contribute to the business over time and not just in the short term. The three defining feature of PPE is they have the physical substance, that they are the tangible assets, you can touch them, you can touch and see them like buildings, machineries, vehicles and computers. PPE is not consumed or sold in ordinary course of business. It is used over multiple periods. Further, these assets are not held for resale. Unlike inventory, PPE is not purchased with the intent to sell. It is meant to support the operations of the organization. So let's look at some examples to bring this into life. A factory building used for manufacturing is clearly an PPE. A machine used in production is clearly an PPE. A vehicle used for delivery and internal logistics is a PPE. Even an aircraft held for rental purposes would qualify as an PPE. However, if the same aircraft is held for resale, it would be classified as inventory but not PPE. Further, land and building which are held to earn rentals or for the capital appreciation rather than for use in production or supply of goods or services or for sale are classified as investment properties and comes under the purview of Ind AS 40. It's equally important to understand what does not qualify as PPE. The assets which are held for short-term use, say temporary site cabins used for a 3-month construction project, any event-specific lighting and sounding system purchased for a single product launch, portable generators used only during a one-off exhibition, construction tools like hand drills purchased for a single small renovation job. Further items which are held for resale like goods in a trading business are inventory. Intangible assets such as patents and software which lacks the physical substance are covered under Ind AS 38 intangible assets and not under Ind AS 16. So now what we understand that what qualifies for PPE, let's move to the next critical aspect. When do we recognize an item as PPE in the financial statements? Recognition is not automatic. Just because an asset qualifies the definition of PPE does not mean that it should be recognized as such. Ind AS 16 lays down 2 essential criteria that must be met before an item is recognized as PPE. According to Para 7 of Ind AS 16, an item of PPE should be recognized only when it is probable that the future economic benefits associated with the item will flow to the entity, and the cost of such item can be measured reliably. So let's break this down. Future economic benefits means the asset must contribute to the generation of cash flows or cost savings to the organization. For example, a machine used in production is expected to help the manufacture of goods that will be sold. A building used for administrative purposes supports the business operations. Further, if there is certain uncertainty about whether the asset will generate future economic benefits, say due to regulatory hurdles or due to operational delays, such recognition should not be accrued in the books and should be deferred until the clarification or certainty about the future economic benefits stabilizes. For example, a company begins a construction of a manufacturing facility, but it is unable to obtain the environmental clearance from the local authorities. Although the company has incurred cost and the asset physically exists, there is no certainty that the factory will be allowed to operate. So as there is no certainty that the factory will be allowed to operate, the future economic benefits are not probable, and accordingly, the assets cannot be recognized as PPE until the clearance is obtained. Another example could be that a company imported a specialized equipment for production. However, after the shipment, the government imposes the ban on the final output intended to be produced from the use of equipment due to safety concerns. So now the equipment is with the company, company has incurred the cost, it has the physical substance and cost can be measured reliably, but it cannot be used. So as the asset's future utility is very uncertain, recognition is not permitted until the regulatory issue is resolved. Another example could be a change in land zoning laws. So the company acquires a land with the intent to build a commercial complex. However, before the construction, the local laws gets changed and the land is now designated only for the agricultural purposes. The company is now unable to use the land for its intended purposes. Hence, the asset cannot generate the expected economic benefits and it fails the recognition test under Ind AS 16. So the second part of the criteria is reliable measurement of cost. The cost of asset must be determinable with a reasonable accuracy. If the cost cannot be measured reliably, for example, suppose a company receives a piece of land from the government as a part of industrial development scheme, the land is granted free of cost and there is no market for similar land in the area. Further, no valuation report is provided. The company cannot reasonably estimate the fair valuation due to lack of comparable transactions. In this case, although the land is tangible and will be used for administrative purposes, the cost cannot be measured reliably. As per Ind AS 16, the asset cannot be recognized as PP unless a reliable fair value can be determined for the land. Let's consider another situation where an entity acquires a piece of equipment through a barter transaction, say exchange of service for a machine. So if neither the fair value of machine received nor the fair value of services provided can be measured reliably, then the cost of the machine cannot be determined with a reasonable certainty. In such cases, Ind AS 16 does not permit the recognition of asset as PPE because the second criteria, the reliable measurement of the cost, is not satisfied. So this is essentially relevant in the non-monetary exchanges without commercial substance, donated assets where the fair value is very unclear, and internal construed assets with the poor documentation or cost tracking. Imagine a company develops a custom piece of machinery in-house using spare parts, labor, and overheads. However, the company does not maintain the proper documentation of parts used. It has no time tracking of the labor involved and cannot allocate the overheads accurately. In this case, even though the asset may be physically exist and be used in the operations, the cost cannot be measured reliably and there is no verifiable basis of valuation. Other important notes in this regard are that the recognition should be evaluated at the time the cost is incurred and not retrospectively. This applies to the initial cost and subsequent cost both. Para 10 of Ind AS 16 emphasizes that the cost incurred after the initial recognition should also be evaluated against the recognition criteria. Let's now delve into a nuanced area of PPE accounting, the capitalization of stores and spares. This is a topic that often leads to the confusion, especially when distinguishing between inventory and capital assets. The core question is, when does a spare part qualify as a property, plant and equipment, and when should it be treated as inventory? The answers lies in the para 8 of Ind AS 16, which provides guidance on this matter. A spare part can be capitalized as PP in below situations. When it is used for more than one accounting period. This implies longevity and continued utility beyond the current financial year or a single accounting year. The PPE is specific to another PPE. The spares is specific to the another item of PPE, which is to be used for more than one accounting period. The spare must be integral to the functioning of larger asset. For example, a turbine blade used exclusively in a specific generator. And the spare must not be held for resale. If the spare is intended for resale, it fails the definition of PPE and falls under the definition of inventory as per Ind AS 2. So if any of the situations arises, then the spare part is not just a consumable item, it becomes a part of the capital structure of the businesses. In other cases, it should be classified as inventory. For example, if the spare is generic and not tied to a specific PPE, it is consumed within a single accounting period, or it is held for the purposes of resale. In such cases, the spare should be classified as inventory. So let's take a case study and consider a practical example. A company has a spare part termed as machinery spares. It is required to be used along with a specific piece of equipment and is expected to last more than one accounting period. So the question is, how should this be treated? The spare is now I hope the answers are visible on the screen. The spare is held for use in the production of goods. It is expected to be used for more than one period, and it is not held for resale. Accordingly, it qualifies as PPE and should be capitalized. This case illustrates how the context and intent of the use are critical in determining the current accounting treatment. So now let's move to a critical aspect of PPE accounting, subsequent cost. This is where many practical challenges arise, especially in distinguishing between capital expenditure and revenue expenditure. Once an item of PPE is recognized and initially measured, the question arises, what happens when we incur cost on it later on? These costs could be the day-to-day servicing cost, could be the replacement of major parts, could be the cost of major inspections or overhauls. The treatment of these costs depends upon whether they meet the recognition criteria or not. Let's start with the day-to-day servicing cost. The most common type, routine servicing. These type of costs include routine repairs, regular maintenance, lubrications, minor adjustments to the machineries, like fixing leaks, replacing worn out belts, tightening the bolts, applying grease or oiling to moving parts. Painting for maintenance, repainting to prevent rust and not for the aesthetic upgrade. Inspection, routine safety checks or compliance inspections. Consumables, coolants, cleaning agents, small spare parts used in regular servicing, or minor parts replacements as nuts, bolts, gaskets, seals that do not enhance the asset of life and they are merely maintain the asset in its current condition and essential for the upkeep of the asset. Such cost should be expensed off immediately in the profit and loss account because they are not they are just merely maintaining the upkeep and not enhancing or not increasing the future economic benefits of the asset. So now consider a scenario. The second cost is the replacement cost of major parts. So consider a scenario where the part of the asset is replaced, say a motor in a machine, an engine in an aircraft, or a roof in a building. If the replacement is expected to bring future economic benefits and the cost can be measured reliably, then it should be capitalized as a part of PPE. But there's a catch. The carrying amount of replaced part must be de-recognized. This ensures that we don't double count the asset's value. For example, replacing a boiler in a captive power plant, the new boiler is capitalized and the old one is removed and de-recognized from the books of accounts. Coming to the major inspection costs, some assets require regular significant inspections to ensure that they remain safe and operational. These inspections are not optional, they are often mandated by the regulations or recommended by the manufacturers to maintain performance and compliances. If the inspection is necessary for the continued use of the asset and meets the recognition criteria, then the cost of inspection is capitalized. Again, the cost of previous inspections must be de-recognized. For example, aircraft, elevators or gas turbines often require major inspections every few years. These costs are not routine costs and they are essential for the asset's continued use. Accordingly, these costs should be capitalized. So let's summarize the accounting treatment of subsequent cost. The routine servicing cost should be expensed off in the P&L account. The cost of replacement of part should be capitalized if they meet the recognition criteria, plus the de-recognition of old part must also happen. And the major inspection cost again, that should be capitalized with the derecognition of old inspection cost. Why this matters? Because the incorrect classification of subsequent cost can lead to overstatement or understatement of assets, misleading depreciation charges, and error in profit reporting. Hence, it is essential to evaluate each cost carefully, document the rationale, and ensure compliance with the standard. So let's look at a practical case involving a petroleum refining company that operates a captive power plant with gas turbine generators. I hope the case study is visible on your screen.
Yes.
So these generators face extreme operating conditions leading to the frequent fractures in critical equipments. As a result, the company performs scheduled overhauls, replacing parts and incurring servicing charges. The key question is, how should the cost of replacement and servicing during these overhauls to be treated under Ind AS 16? So the replacement of critical parts are essential for the continued use of the asset. They meet the recognition criteria, that is, future economic benefits are available to the entity and the cost measurement can be done reliably. It implies that the capitalization of the cost can be done in the generator's carrying amount. Further, we should also be derecognizing the carrying amount of replaced parts. On service charges, if they are not part of the overall and not routine maintenance and contribute to the future benefits, they should be capitalized. Sorry, if they are part of the overall and not routine maintenance, they should be capitalized. Otherwise, if they are just day-to-day routine maintenance servicing charges, then that should be expensed off. The treatment aligns with the para 7 of Ind AS 16. So the case actually highlights the importance of evaluating the nature of subsequent cost, applying recognition criteria consistently, and ensuring derecognition of replaced components. Proper classification ensures accurate asset valuation. So now that we have understood the recognition, let's move to the initial measurement of property, plant and equipment. This is a foundational concept under Ind AS 16 and it determines the value at which an asset can enter the books of accounts. When an item of PPE is first recognized, it is measured at cost. But what exactly constitutes a cost? It is just not the purchase price. It includes several directly attributable costs that are necessary to bring the asset to the location and to the condition required for it to operate in the manner intended by the management. So let's break down the key component that must be included in the cost of PPE. So first is purchase price, which is net of discounts and rebates. Another one is non-refundable taxes and credits. So if we have paid any import duty on the imported equipment and that is not creditable, then the cost of such import duty paid can be added to the cost of PPE. Directly attributable cost. And now what is this directly attributable cost? So directly attributable costs are the costs that are essential to bring an asset to the location and in the condition necessary for it to operate as intended by management. Employee benefits. So one of the example of whether the inclusions would be the employee benefits directly related to the construction or acquisition. Example, salaries of engineers working on site to install a new production line. Site preparation cost, land leveling cost, soil testing cost before the construction of a factory. Initial delivery and handling cost. For example, freight charges for transporting heavy machinery from supplier to the plant location. So this means that primary freight charges to bring the asset in the plant location should be capitalized. Installation and assembly cost charges paid to the technician or the vendor for the assembling of a plant. Testing cost. So this is an important aspect, that if any cost incurred during the testing of the trial run or the testing of the plant and machinery, the amount or the expenditure incurred on the testing can be capitalized, but must exclude the proceeds earned from the sale of test output. For example, 5 lakh spent on testing new machine, 1 lakh earned from the selling of test products, then 4 lakh must be capitalized. Any other professional fees, for example, architects and structural engineers fees for the designing of the warehouse or the factory or the office building, whatever it may be. The third component is the decommissioning and restoration cost, which says that the initial estimate of dismantling and site restoration should be recognized as a part of PPE, and corresponding liability should be recognized under Ind AS 37, provision and contingent liabilities. For example, if you expect that 10 lakhs would be spent on the dismantling of a wind turbine at the end of its life, then the present value of that 10 lakh should be recognized as a part of PPE, and the corresponding liability should be recognized as a liability. There are certain exclusions from the cost. So now let's look at what should not be included in the cost of PPE. General administrative overheads. Example, salaries of HR and finance staff not directly involved in the asset acquisition. Cost of opening new facilities. Cost of new products and service launch, for example, marketing expenses. Cost of conducting business in a new location, example, relocation cost, redeployment cost, including staff training. For example, if you move a machine from one plant to another, that the cost of that movement should not be capitalized. So the inclusions and exclusions matters because it ensures the accurate asset evaluation, correct depreciation base, and transparent financial reporting. Let's take a closer look on how we determine whether a cost is capitalizable, and more importantly, what must be excluded to ensure compliance. These exclusions ensure that the asset is not overstated and that costs which is only relevant are capitalized. The guiding principle is very simple but very powerful. Only those costs that are necessary to bring the asset to the location and the condition required to be operated in a manner intended by the management, it should be capitalized. So this means that in the right location, that a heavy machine delivered to company's warehouse but not transported to the factory floor. So because the management wants to use in the factory, it is not the right location for the machine. So hence any cost till the transportation to the factory floor can be capitalized. Second factor is it should be in the right condition. A generator or a plant and machinery delivered in parts to the factory but still awaiting the assembly and testing cannot be capitalized because it is not in condition to be used by the management. Further, it should be ready for use as per the management's intent. So for example, if a construction of an office building is completed, but electrical and IT systems are not installed, so that employees cannot move in. So it is not ready, although the factory building is civil work is completed, but it is still not in the form of or in the manner of to be used in the manner intended by the manager, because management intends it to use for the administrative purposes and employees cannot move in. Another example would be if an office building within the premises of factory is ready, but the factory itself is not ready. So the intention of the office building was to use in the factory day-to-day affairs or the support factory's administrative purposes. So in this case, although the office building itself is ready in the right location, in the right condition, but it is not ready to be used in the manner intended by the management. So in such cases, any cost incurred till the date factory building is ready or factory is ready can be capitalized in the cost of office building, provided that the cost is actually incurred for the office building. What must not be capitalized? So now let's talk about the cost that must be excluded even if they seem related to the asset. Cost incurred after the asset is ready to use but not put to use. So in accounting concept under Ind AS 10, under AS 10, under Ind AS 16, the concept is asset is available for use or ready for use. However, in the income tax, the concept is cost incurred till the put to use. So once the asset is ready to use but cannot be used due to any other reasons, the cost incurred after such date cannot be capitalized in the accounting books. However, in the tax books, the cost till the actual usage of the asset can be capitalized. Relocation and redeploying costs. For example, 1.5 lakh spent to move a machine from one plant to another plant. Say I have 3 plants. I have capitalized a plant and machinery in one plant. Now I want to move it to another plant. And so what should I capitalize the transportation cost? The answer is no, because the machinery was first intended to be used in plant A. Now the intention and the plant is already running. Machine is capable to be operated in the manner intended by the management. So any cost incurred in redeploying should not be capitalized. Idle time losses. For example, in first month of the operations, the company incurs the loss of 50 crores due to underutilization of the machinery. So this cost is in a P&L item and should not be capitalized as a part of PPE. Abnormal cost. So 1 lakh spent on the fixed damages caused by incorrect installation, or for example, there are protests erupted in the vicinity of the factory building, due to which the construction is not yet completed, due to which the additional cost or abnormal cost has been incurred by the entity. So those costs must not be capitalized. Income from non-incidental operations should also be excluded from the adjustment of the PPE. Any internal profit, for example, if I sell the equipment at a markup in the market, but I require the same equipment for my PPE, then I should not transfer it to PPE from inventory on a markup. The markup or internal profit should be eliminated from the cost of PPE. So let's take a case study on car park income before the construction site. A company earns income from a car park on a site where a new building is to be constructed. Should this income be netted off against the cost of building? The answer is no, as this operation is incidental but not necessary to bring the asset to its intended condition. If I do not use the building, if I do not use the site before the construction of a building as a car park, no impact it would have on the building. So the cost is incidental, but it is not necessary, or the income is not necessary to bring the asset to its intended condition. Hence, both income and related expense, which may be incidental to the asset, but that are not necessary to bring the asset in its intended condition, should be charged to P&L and should not be capitalized. So misclassification of the cost can lead to the overstated assets, incorrect depreciation, and misleading financial statements. Hence, it is essential to apply the judgment, document the rationale, and align with the Ind AS 16. So let's consider a practical scenario, a case involving ABC Limited, which is a company which is setting up a refinery outside the city limits. To facilitate the construction, the company incurs certain expenditure on building the railway sidings, roads, and bridges. These assets are accessible to the public but are not owned by the ABC Limited. So now the key question is, can ABC Limited capitalize the cost of these infrastructure developments as a part of PPE? So as per para 7 para 7 and 16 of India 16, any cost that is directly attributable to bringing the asset to location and condition necessary for it to operate in the manner intended by management qualifies for the capitalization. Although ABC Limited does not own the railway siding, road or bridges, these are essential for the construction and operation of the refinery. Therefore, the cost is capitalized as a part of overall PPE and allocated across the refinery assets. Please note that these costs should not be capitalized as a separate item because the company does not have an actual control or ownership rights to these assets and would not qualify the criteria or the definition of an asset. However, these costs can be capitalized as PPE because these are directly attributable and these are necessary to bring the asset into condition intended by management. So it should not be capitalized separately, but should be capitalized as a part of overall refinery assets, should be allocated. The ownership is not the sole criteria for capitalization. If the infrastructure is necessary for enabling the asset to function, the cost meets the recognition criteria and should be included in the initial measurement of PPE. Let's consider another case where a company plans to construct a hotel on a land currently occupied by the residents. To proceed, the company agrees to relocate the residents to another site at its own cost. So the question is, can the cost of relocating the residents be capitalized as a part of cost of land? Yes, it can be capitalized. Again, as per para 16, any cost which is directly attributable to bringing the asset to the location and the condition necessary for its intended use qualifies for the capitalization. The relocation cost is a direct consequence of acquiring and preparing the land. It is directly attributable to the asset and should be considered as site preparation cost necessary to make the land usable for hotel construction. So even if the cost does not relate to the physical asset, so in previous example, we saw the cost actually was related to the physical asset itself, but in this scenario, the cost was actually not related to the physical self. Even if in that case, it is essential to enabling the asset for use, it should be capitalized or included in the initial measurement. So the next case study is where a company is trying to obtain the regulatory permissions such as change of land use and environmental clearances for construction of a factory building. So the question is, can these permission related costs be capitalized as a part of cost of factory? So the answer is yes, they can be capitalized, but conditionally. So as per para 7, the cost must be evaluated at the time they are incurred. If there is a sufficient evidence that the permissions will be granted and the cost will result in future economic benefits, then they can be capitalized. However, if the costs are expensed initially, they cannot be capitalized later on, even if the permissions are granted. So what we need to do, we need to anticipate whether the permission would be granted or not. If the grant of permission is probable, it means that the future economic benefits will flow to the entity. In such cases, the amount can be capitalized. However, that evaluation has to be done at the time of the incurrence of cost and not on a retrospective basis. Because once you decide that the cost should not be capitalized, you cannot capitalize it later on when the actual permission eventually arrives. So the capitalization depends upon the timing of evaluation, probability of benefit, and reliable measurement. Once expensed off, the cost cannot be reversed into capital assets later on. So these case studies we have discussed highlight a fundamental principle in PPE accounting, that costs that are directly attributable to bringing an asset to its intended location and condition for use are capitalizable even if they do not relate to the physical asset. These cases reinforces the importance of judgment, timing, and documentation in evaluating whether a cost meets the recognition criteria. Ownership is not always necessary. Functionality and necessity are what matters the most. So this slide explains how to treat non-standard costs like cancellation fees and liquidated damages in context of PPE. So scenario is a company pays a cancellation fees for equipment it is decided not to procure. Another scenario is it incurs LD for failing to meet the performance conditions. Separately, it receives LD from a contractor due to project delays. So the cancellation fees is not capitalized and it is not directly related to bringing any asset to its intended condition. Because this cost is not necessary and not in any way directly attribute to the asset, should be treated as the expense. Liquid damages paid are not deducted from the PPE cost because these penalties are for the inefficiencies and do not qualify as trade discounts. These kind of damages should also be charged to the P&L account. Liquidated damages received can be capitalized only if they are directly linked to mitigating the project cost. So I have the contract was such that if the vendor will delay the project delivery, he will have to pay me back or the organization back LD in the proportion of the price of the asset. So what happens? This cost is actually, this income is for the mitigation of additional cost which I might incur due to delay in project. So this is actually directly linked to the asset and can be added to the assets cost. But it must be very clearly identifiable with the project. So takeaway is only costs that are necessary and directly attributable to making the asset operational should be capitalized. Penalties and unrelated compensation should be treated as income or expense and do not not adjustments to the asset's value. So let's now explore a critical but often underreported aspect of PPE accounting: decommissioning and restoration liabilities. These are future obligations that arise at the time of asset acquisition or installation and must be accounted for immediately, even though the actual cash outflow may occur decades later. The concept is governed by Ind AS 16 and Ind AS 31 along with Appendix A to Ind AS 16. So we must understand what are the decommissioning liabilities. These are the costs that an entity expected to incur to dismantle or remove an asset at the end of its useful life and restore the site to its original or legally required condition. Such obligations are common in oil and gas exploration industry, mining operations, power plants, telecom towers, wind farms, etc. And these are also very common in the lease properties with the return conditions. For example, aviation, every aircraft has return conditions if they are on the operating lease. For example, a company install a captive power plant on leasehold land for 99 years, and as per the lease agreement, the company must return the land in its original condition. The accounting treatment of such liabilities involves two simultaneous entries. One is on the asset side, that the present value of estimated decommissioning cost is added to the cost of PPE. This amount is then depreciated over the useful life of the asset. And another is on the liability side. A provision is created under Ind AS 37. Over time, this provision liability is unwound using the effective interest method, and the unwinding cost is recognized as finance cost in profit and loss account. So let's now examine a real-world scenario that brings together the principle of Ind AS 16 and 37, specifically around decommissioning and restoration liability. So company ABC has received a land on lease of 99 years from the government to carry out its activities. As per the terms and conditions of the lease, the company is supposed to return the land to the government after 99 years on a as it is where it is basis. At the inception of the lease, the land is utilized by the company and the building has been constructed. Further, as per the Ind AS 16, the cost of the item of the property, plant and equipment comprises the initial estimate of the cost of dismantling and removing the item and restoring the site on which it is located. Management is of the view that the scrap value derived at the end of lease period from the demolition of the project will compensate for the cost of demolition of the project. So in that case, how should the company account for such decommissioning and restoration cost? So in this case, the management believes that the scrap value from demolishing the building will be sufficient to cover the cost of demolition. So the question arises, should the company recognize a decommissioning liability at the inception of lease? Because the scrap value will cover the cost. So is there any obligation on the part of organization? The answer is yes. The company must recognize the decommissioning liability. So as per para 16, as per Ind AS 16 plus Appendix A plus Ind AS 37, the initial estimate of the cost of dismantling and restoring cost must be capitalized as a part of PPE and should be recognized as a liability at present value. Even if the scrap value is expected to offset the cost, it should be treated separately as the residual value of the building. It affects the depreciation, not the recognition of liability. For example, say estimated demolition cost after 99 years is 10 crores. Present value of this cost is 1 crore and estimated scrap value is say 1.5 crore. So accounting treatment would be 1 crore is added to the cost of building and depreciated over its useful life. 1 crore is recognized as the decommissioning liability. The 2 crore scrap value is treated as residual value and reduce the depreciable base. Further, going forward, each year the building is depreciated based on the cost minus residual value. The liability is increased due to unwinding of cost and the finance cost is charged to the profit and loss account. So this case highlights a key principle. Decommissioning liabilities must be recognized when the obligation arises, not when the cost is incurred. Ignoring this can lead to understated liabilities, overstated or understated net assets, misleading financial statements. So we must always assess the lease agreements for restoration clauses. We should take the estimate of dismantling the cost with the technical inputs, and we should use the appropriate discounting methods to arrive at the present value of the estimated cost. We should also treat this correctly. Moving forward, now let's discuss two special cases under initial measurement that often create confusion in practice. One is deferred credit terms and another is exchange of assets. These situations are common in industries like manufacturing, infrastructure, and aviation, and they can significantly impact how we determine the cost of an asset. So, when an asset is purchased on deferred credit terms, meaning the payment is delayed beyond normal credit terms. For example, normal credit terms are 30 days, but the vendor is suggesting that okay, if you want to purchase it, we can defer the credit terms till 1 year. So in those cases, we cannot simply take the total payment as the cost of the asset. Why? Because the extra amount is not part of the asset, but it is a financing cost. So the asset should be recorded at its cash equivalent price, the amount we would have paid if we had settled the liability immediately. And the difference between the cash price and total payment is recognized as borrowing cost under Ind AS 23 if it qualifies the criteria of qualifying assets. If it does not, in such cases, it should be charged off in the profit and loss account. The example would be a steel manufacturer buying a rolling mill with a cash price of 50 crore but agrees to pay 55 crore over 4 years. In such case, the PPE would be recorded at 50 crore and the extra 5 crore is treated as an interest and expensed off over the credit period. A car dealership buys showroom equipment for 10 lakhs with a deferred payment plan totaling to 12 lakh over 3 years. In such cases, 2 lakh is interest and not should form part of asset cost. So, why do we think that Ind AS separates the financing cost from the asset cost? Because the asset's value should reflect its economic worth and not the cost of financing. The second aspect is exchange of assets. So sometimes PP is acquired in the exchange of another asset, monetary or non-monetary. So two conditions must be satisfied to measure fair value. The exchange has a commercial substance, meaning it changes the entity's future cash flow significantly. The fair value of the asset given up or acquired can be measured reliably. Although it's a very theoretical concept, there are very few cases of this concept which arises in day-to-day life. But if both the conditions are met, we measure the new asset at fair value. Otherwise, we use the carrying amount of the asset given up. What does commercial substance mean in this case? So commercial substance means that the exchange transaction significantly changes the entity's future cash flow in terms of risk, timing, or amount. If the exchange does not affect these factors, it lacks the commercial substance and should not be measured at fair value. So now, how to assess the commercial substance? An exchange has commercial substance if the configuration, that is risk, timing, and amount of cash flows of the asset received differs significantly from the assets given up. The entity-specific value of the asset received differs significantly from that of the asset given up. And the difference is material relative to the fair value of assets exchanged. So let's understand this from the help of one example. A construction company exchanges an old crane for a new concrete mixture. The new mixture allows the company to take on high-value projects it could not have handled before. Accordingly, the future cash flow increases and the exchange has the commercial substance and the asset must be measured at the fair value. A logistic firms trade a standard truck for a refrigerated truck to enter the cold chain business. So this now opens a new revenue stream and changes the nature of operations. Again, the commercial substance exists as it changes the timing, extent, and amount of cash flow generated from the operations. And the exchange should be measured at the fair value. There can be cases where no commercial substance exists. For example, company exchanges similar trucks of the same capacity and the age. No significant change in cash flow, risk, or operations. That means the transaction does not has the commercial substance and it should continue to measure the carrying amount of asset given up. So why do we think that Indians require commercial substance to be the first condition to recognize the exchange of assets? Because without it, the companies could manipulate the profit by revaluing asset through meaningless swaps. These adjustments ensure that the cost reflects the true economic value of the asset and not financing or unrelated factors. Next, we will explore the subsequent measurement models, cost models versus revaluation model. So, till now, we have recognized the PP at its initial cost. The next big question is how do we measure it in the future? So India 16 provides us two models for subsequent measurement. One is cost model and another one is revaluation model. Both approaches has different implications for financial reporting, ratios, and even investor perception. First, the cost model. Under this model, the asset remains at its original cost, less accumulated depreciation and impairment losses. This is the simplest and most widely used approach in the India because it avoids the frequent fair value assessments and provides stability in the financial statements. This method is a historical cost basis method. The asset remains at its original purchase price, including obviously directly attributable costs, and no periodic adjustment for changes in the market value. Depreciation under this method is charged systematically over the useful life, and impairment testing is required under Ind AS 13 if there are the indicators of impairment. There are no fair value adjustments under this method, unlike the revaluation model. There is no requirement to reassess fair value periodically. This avoids the volatility in the financial statements. The advantage of cost model is it is simple and cost effective, predictable impact on the financial statements. However, cost method may not reflect the current market value of the asset, especially in the industries where asset prices fluctuate significantly. Under the revaluation model, the asset is carried at fair value, less subsequent depreciation and impairments. But there are very strict rules. The choice between cost and revaluation is a accounting policy decision. Further, it must apply to entire class of assets, not selectively. Revaluation should also be done with sufficient regularity to keep the carrying amount close to fair value. So the point to be noted is that the revaluation is not required to be done annually, but to be done with the sufficient regularity so that the actual market value of the asset does not significantly differs from the carrying value. The real life examples would be entities managing airports sometimes revalue their runways or docks because these assets appreciate over the time. Hotels often revalue their land and building in prime location to reflect the market appreciation. Sometimes state-owned utilities revalue power plants and infrastructure to align with government valuation norms. So why do you think that the question is why the valuation model is to be chosen for entire class and not for the selective assets? So it is done with the intention to prevent the cherry picking. For example, if you revalue one building, you must revalue all buildings in that particular class. This ensures consistency and avoid manipulation of profits. So imagine your company owns 10 buildings across India. One of them is in Mumbai and its market value has skyrocketed. Can you revalue just that one building to boost your balance sheet? The answer is no. India 16 says if you adopt the revaluation model, you must apply it to entire class of asset and not just a single item. Let's understand why. India 16 wants to prevent the cherry picking. If the companies could revalue only their most valuable asset, they could artificially inflate the net worth and mislead the investors. So the rule is a class of asset is assets of a similar nature and used in operations. Examples of classes is land, buildings, plant and machinery, furniture, fixture, vehicles. So factory building can be a different class of asset, and office building can be a different class of asset. If you revalue your one factory building, you must revalue your all factory building in that class if that is being disclosed in your financial statements. So the case, let's understand with the help of case study. Company A has the textile manufacturing facilities in two different geographical locations. Question is, how can they classify these different classes of property, plant and equipment based on geography? So basically, a company wants to classify both manufacturing facilities as different class of PPE based on their different geographical location, whether they are permitted or not. So answer is no. Both the facilities produce similar products and have similar use, so they belong to the same class of assets. However, if one facility manufactures textile and the other facility manufactures the pharmaceuticals, they can be classified as different classes because their nature and use of the assets differs. So all hotels in a chain are considered as one class of building. If you revalue one hotel property, you must revalue all hotel properties. All aircraft form one class of asset. You cannot revalue the newest, latest technology aircraft. All turbines in power plant are one class. If you revalue one turbine, you must revalue all turbines. All server in a data center are one class. If you revalue one, you must revalue all. So this requirement ensures comparability and transparency. It also means revaluation is a strategic decision and not just about one asset. It impacts your entire asset class and your financial resource. Now let's tackle another common question. If a company acquires another entity and measure assets at fair value, does it need to revalue its existing assets? The answer is no, and understanding why it is critical for the compliance and financial strategy. So entity A acquires entity B. As per Ind AS 103, entity A must measure B's identifiable assets and liabilities at acquisition date fair values. Does this mean that entity must also revalue its own existing assets? No. Or why? The key principle is Ind AS 103 deals with the initial recognition of acquired assets during a business combination. Ind AS 16 governs the subsequent measurement of PPE and initial recognition. The fair value exercise under Ind AS 103 is a one-time requirement for the allocation of purchase price. It does not mean that the company has adopted the revaluation model under Ind AS 16. So unless the entity A formally changes its accounting policy to adopt the revaluation model for the entire class of assets, its existing PPE remains under the cost model. The real life examples could be entity in the manufacturing sector. Entity A acquires entity B and records B's plant at 100 crore, which is actually the fair value. Entity A's own plant remain at cost, which is 80 crores, unless it decides to adopt the revaluation model for entire class of PPE. Another example would be telecom merger, where two telecom companies merge. The acquired companies towers are recorded at fair value under Ind AS 103. The acquiring company's tower remain at cost unless the revaluation model is adopted. Hospitality industries could be another example, where hotel chain acquires another chain and record the acquired hotels at fair value. Its own hotel remains at historical cost unless the company changes its policy to revalue all the hotel properties. So that distinction is critical because some company mistakenly thinks the acquisition fair value means they must revalue everything. That is incorrect. If you want to revalue your own assets, you must formally change your accounting policy, apply it to entire class of asset, and ensure that regular fair value assessments has been done going forward. This is a strategic discussion because it impacts the net worth, debt covenants, volatility in OC, and audit complexity. So now that we understand the classes and business combination, in the next step is to see how revaluation gains and losses are accounted for. That is coming in next slide. This is critical because it impacts both balance sheet and profit and loss statement. Revaluation gain, when an entity's value increases on revaluation, the first time gain goes to the other comprehensive income and is accumulated in revaluation reserve under equity. Under other equity. Other comprehensive income. For subsequent revaluations, if there was a previous loss recognized in P&L, the gain first offsets that loss in P&L and the remaining goes to the other comprehensive income in revaluation reserve. For example, suppose an asset has a carrying amount of 100 and after revaluation it becomes 120, the 20 goes to the other comprehensive income revaluation reserve. If in the past we had already recognized that loss of 10 rupee in the P&L, then first 10 rupee gain will go into the P&L and the remaining 10 rupee gain will go into the OCI. On the other hand, in case of revaluation loss, where the assets value decreases based on the fair value of the market fair value, the first time loss is actually recognized in profit and loss statement, and the subsequent revaluations, if there is a balance in revaluation reserve for that asset, the loss first reduces the reserve and any excess goes to the P&L account. For example, if an assets value drops from 120 to 90, the 30 goes to the P&L, but if we had a 20 rupee revaluation reserve,
can I just borrow a check?
Yeah, sure. If we had a 20 rupee revaluation reserve, then rupee 20 reduces the reserve and 10 hits the P&L. So the note is entities can transfer the revaluation surplus to the retained earnings when the asset is disposed of or gradually as the asset is used. But this transfer is not routed through profit and loss statement. So let me start with the question. Why do we depreciate assets? Is it because the asset loses its values over the time? No, not exactly. Depreciation is about allocating the cost of an asset over its useful life, not about tracking its market value. Remember the fundamental problem in financial reporting: expense incurred in one period, benefits flow in multiple periods. That is why we allocate the cost of an asset over its useful life. The core concept is depreciation is a systematic allocation of depreciable amount of an asset over its useful life. Depreciable value is cost of an asset reduced by the residual value, whereas the residual value is the expected amount on disposal of PPE at the end of life. Useful life is a period over which an entity is when an asset is expected to be available for use, or the number of units expected to be obtained from the assets. Depreciation must to be charged in P&S unless the asset is being used in the production of another asset. In such cases, that can be capitalized at the cost of the other asset. So the key principles are when the depreciation starts. Depreciation starts when the asset is available for use. Again, unlike the under income tax, where depreciation is allowed from the date of actual uses, in accounting scenario under the accounting standards or the Indian accounting Ind AS, the depreciation starts when the asset is available for use, even if it is not being put to use, or not when it started generating revenue. So for example, a machine installed in March, but the production started in April and the sales started in, say, May. The depreciation started in March itself. Further, the depreciation continues even the asset is idle or if its fair value is more than the book value. Depreciation does not stop if the asset is idle unless the residual value is more than or equivalent to the carrying amount. For example, a seasonal plant shut down for 3 months still incurs the depreciation even if the plant is idle. When does the depreciation stops? Depreciation stops when the asset is either de-recognized as they do not further have the future economic benefits incurring to the entity, or sold to any other entity, or when it is actually qualified as held for sale. So when now the useful life residual value becomes the estimates and impacts the depreciable value over the period of asset. So now what should be the frequency of review of estimates and how the change in accounting estimates should be accounted for. Useful life and residual value must be reviewed at least annually. If there is a change, it is treated as a change in accounting estimate under Ind AS 8 and accounted for prospectively. So the application is prospective, and we will recalculate the depreciation for remaining useful life based on the revised estimates or revised residual values. So for example, a machine costed 10 lakh, residual value is 1 lakh, useful life is 10 years. After 3 years, management revises useful life to 8 years. So now original depreciation for 3 years was 2,70,000, 90,000 each for 3 years, and the carrying amount was 7,30,000. The remaining life is now 5 years, that is revised estimate of 8 years reduced by the life already spent, which is 3 years. The new depreciation would be 7,30,000 divided by 5 years, which is 1,46,000 per year. So we should always disclose the nature and effect of change in estimates in the financial statements. Other key pointers would be land and buildings are to be depreciated separately even if they are purchased together. Repairs and maintenance do not eliminate the need of depreciation, and depreciation does not stop even if asset is idle or the market value of the asset increased. So why do you think that Ind AS requires annual review of useful life? Because the technology changes fast, and think of an IT equipment or telecom towers where you do not know what technology may come around in the next 5 years. If your company buys a 50 crore machines and expect it to use for 8 years, but after 2 years you realize that it will only last 5 years, then in that cases you should immediately re-estimate or revise the estimate and account for the changes accordingly and account for depreciation prospectively. So now what we know, now that we know the principles and how to handle the changes in estimate, the next question is, which depreciation method should be used? India 16s allow flexibility, but the methods must reflect the pattern in which assets' future economic benefits are consumed. There are three main methods under India 16. One is straight line method, that is equal depreciation every year, and it can be used in cases where assets provides even benefits over its useful life. The example could be buildings, offices, office building, hotels, factory building. Furniture and fixture. And long-term infrastructure assets. So the benefits of this method is this is a simple and predictable method, easy for budgeting and reporting. However, these method does not reflect the actual uses if the benefits decline over the time, and it may overstate the profit in earlier years for fast varying assets such as IT equipments, machineries. The second method is WDV, which is diminishing balance method. It actually provides for the lower depreciation in later years. This method can be used when the assets benefits reduced over the time or maintenance cost rises later on. Examples could be vehicles, cars, trucks, heavy machinery, IT hardware. Benefits of this method is this matches the higher benefits in early years with higher depreciation, and they are also tax friendly in some jurisdictions like us. However, this method is often has complex calculations and may understate the asset value in later years. The third method is unit of production method. It is basically depreciation based on actual uses or output of the asset. This method can be used where the wear and tear depends on the users and not on the time of the asset. Examples could be aircraft engines based on flying hours, mining equipments, power generation turbines, or a mold in the automotive industry. Benefits, this is the most accurate for users driven assets, and this aligns the cost with the actual production. Whereas this method requires a detailed tracking of users and not suitable for time-based wear. So SLM is, we understood that office building depreciated evenly for 30 years. Hotel property could be another example. Example of WDV could be delivery fleet, construction equipment, and UOP is coal mine and printing presses. For example, if you go and buy a projector and you ask for the life of the asset, the seller would not give, say, 3 years, 5 years. It will say X number of hours. So in those cases, the actual depreciation should be calculated over the based of production and not the time. Important is the method should reflect the consumption pattern of economic benefits. The method must also be reviewed annually, at least, and if the pattern changes significantly, then in such cases, method should be changed. Change in method again is change in an accounting estimate, and which says should be applied prospectively. So, for example, a company uses SLM for a machine, but later on realizes that usage is uneven and switches to the unit of production method. So, past depreciation remains unchanged. There is no retrospective application. Only the future depreciation is calculated based on the units produced. So next, we will look at a real case study. Where the unit of production method is applied in practice. So now that we have already discussed the three main depreciation methods, let's apply this knowledge to a real life scenario. This case study will help us understand when the unit of production method is appropriate and what mistakes company often make. So the case study is an automotive company has various type of tools used on a car manufacturing process. These tools are specific to a particular car variant and cannot be used for any other purposes. The company maintains a detailed 5-year production plan and can reliably estimate the number of units to be produced. So can company apply the unit of production method? So under Ind AS 16, the depreciation method should reflect the pattern in which assets' future economic benefits are consumed. For these tools, the benefits are linked to the production value and not production volume. The company reliable estimates may lead to the misleading depreciation charges. If the 5-year plan is too optimistic or too frequently revised, depreciation may be understated or overstated. It ignores the idle time. Companies sometimes stop the depreciation when production halts, which is actually a misalignment with the accounting standard because the Ind AS 16 says depreciation should continue if the asset is available for use unless UOP is applied strictly. Sometimes companies often do not have the estimates of total production outputs. In such cases, total company forgets, so it may result in over or under depreciation. Sometimes company apply you a time-driven asset, for example, office furniture, which is actually very incorrect. So we must track the annual uses. It's very difficult to estimate the residual value in the UOP method, and it is also brings complexity in the asset register. UOP applying UOP to some tools and SLM WDV to other can complicate the fixed asset accounting. Benefits are matches cost with actual production, provides product costing accurately. And disadvantages are requires a detailed tracking and not suitable for assets where time-based wear is significant. So we must always ensure that the basis of UOP, like production estimates, is documented and reviewed annually. If estimate changes significantly, treat it as an accounting change and apply prospectively. Let's move to one of the important concepts under Ind AS 16, component accounting. The principle is simple, but again powerful, very powerful. When an item of PPE consists of significant components with different useful lives or different pattern of consumption, each component should be depreciated separately. Why is this necessary? Because a single asset like building or a power plant often has a part that wears out at different rates. For example, the roof of a building may need a replacement every 10 years, while the main structure may last for the 30 years. If we depreciate the entire building over 30 years without separating the roof, we would understate the expenses in earlier years and overstate them in the later years, leading to the distorted financial results. How component accounting works? First, we need to identify the significant component of an asset that have cost material to the total cost and which has different useful life or the consumption patterns. Allocate the total cost of the asset to the components on a reasonable basis. Then depreciate each component separately over the respective useful life of the component. For example, factory building costs 15 lakh and the roof has cost 1 lakh, which needs replacement every 10 years, then the roof should be depreciated over the period of 10 years, while the remaining structure is depreciated over the period of 30 years. This ensures the accurate matching of cost with benefits. So, what are the practical challenges in component accounting? Identifying these significant components, determining what is significant require a judgment, and Ind AS or the accounting standards does not prescribe a fixed threshold. So the companies need to make their internal estimates and the internal policies to arrive at the conclusion of significant component or the threshold. Cost allocation: often invoices do not provide a breakdown of component costs. In such cases, companies rely on the technical experts, vendor estimates, or the replacement cost methods. System complexity: maintains separate depreciation schedule from multiple components, increase the accounting complexity, and require robust ERP systems. Frequent replacement and derecognition: when a component is replaced, the old component's carrying amount must be derecognized, which can be challenging if its value was not tracked separately. So in summary, component accounting ensures that the depreciation reflects the actual use consumption pattern of each part of the asset, leading to more accurate financial statement. While it adds the complexity, it is essential for the compliance and transparency, especially for large capital intensive industries like power, aviation, oil and gas, manufacturing. Now that we understand the concept of component accounting, let's address a practical challenge. How do we allocate the total cost of an asset to its significant component when the invoice does not provide a detailed breakup? This is a common issue in industries like power, oil and gas, and manufacturing, where assets such as captive power plants or large machinery consist of multiple significant components: boilers, turbines, aircraft. In case of aviation, engines is a significant component. Further, if you break down the engine, there are multiple components itself, which each has the different useful life. So Ind AS 16 requires us to depreciate these components separately. But what if the vendor invoice only shows a lump sum amount? So Ind AS 16 provides a guidance which says the company to use a reasonable and consistent basis for the allocation. The standard suggests to follow the hierarchy, which is the first and the foremost is ask the breakup from the vendor. If the breakup is provided by the vendor, it is the most reliable source and can be used for the component accounting. In case the breakup is not provided by the vendor, then we can go to the technical expert and ask their estimate. Internal or external engineers can provide the cost allocation based on design and specification of the asset. The third comes for the fair value of components. If the market price of similar components are available, we can also use them. And the last option would be to use the current replacement cost method, which is estimate the cost of replacing each component today and allocate proportionately to the historical cost. So example of cost allocation is the vendor has already provided captive power plant and the total was 75 crore. The provider split that boiler is 35, turbine is 25, generator is 15. So these can be used. Technical expert: if the vendor does not provide detail, a technical expert estimate the cost based on design and specification. That boiler is 45% of the cost, turbine is 35% of the cost, generator would be around 20%. Then these also can be used. If we know the current replacement cost of boiler is 40 crore, turbine is 30 and generator is 20, total comes to the 90 crore, and then we will allocate the individual cost of these items to arrive at original value of 75 crore in the original ratio. So the practical challenges are sometimes we lack the vendor support. There is a huge dependency on the estimates. Engaging experts and performing valuations can be expensive and time consuming. And there is a system complexity because of maintaining the separate depreciation schedule for multiple components requires robust ERP system and internal controls. So in summary, cost allocation for component accounting is not just a compliance requirement, but it is a critical step for accurate financial reporting. While it adds the complexity, it ensures the depreciation. So now let's discuss an important aspect of subsequent cost under Ind AS 16. The case study here involves a company that acquires an aircraft for 800 crores with the useful life of 20 years. The aircraft is required to undergo major inspection and repairs every 5 years. The estimated cost of each overhaul is 150 crores, which includes 50 crores for inspection and 100 crores for replacement of parts. The question is, how should these costs be treated in books of account? So cost of replacing part of PPE should be capitalized as per para 13 if they meet the recognition criteria, and the carrying amount of replaced part should be de-recognized. Major inspection costs should also be capitalized and depreciated over the period until the next inspection. And significant components with different useful life should be depreciated separately. So when an aircraft is purchased, the initial cost of 800 crore is capitalized. At the time of overhaul, the company incurs 150 crores. So 100 crores is for the replacement. This should be capitalized as a new component. 50 crores is for the inspection. This should also be capitalized and depreciated over the 5 years until the next inspection. And the total of 150 crore is added to the carrying amount and depreciated over the next 5 years. Please do not forget to de-recognize the old part or the old inspection cost capitalized in the assets gross value. So there are certain practical challenges like identifying the carrying value of amount of replaced part. If the original cost was not split into component accounting, estimating the value of replaced part can be difficult. There is a lot of judgment involved in the capitalization. Distinguishing between day-to-day maintenance and major overhaul requires judgment. Large periodic costs can affect liquidity. Companies often plan for these through maintenance reserves. These require the robust asset tracking and component level accounting in ERP systems. So in summary, major overhaul and inspection costs should be capitalized and depreciated over the period until the next overhaul, ensuring compliance and accurate reflection of asset value. This approach is critical in industries like aviation, power, and oil and gas, where such costs are significant and recurring in nature. So now let's discuss the final stage in this life cycle of property, plant and equipment, de-recognition. Under India 16, an item of PPE should be de-recognized when it is disposed of or no future economic benefits expected from its use or disposal. The gain loss on de-recognition is calculated as sale proceeds reduced by the carrying amount of the asset, and it should be recognized in the profit and loss account. However, the same should not be classified as the revenue. So, for example, a machine is sold for 10 lakh and the carrying amount is 8 lakh, then the gain of 2 lakh should be recognized in profit and loss account. And if it is sold for 6 lakhs, then in that case, it should the loss should be of 2 lakh should be recognized in profit and loss account. Another example could be replacement of component, which we have already discussed in the previous slides. So the question is, what are the scenarios where no future economic benefit is further expected from the asset? So, for example, an obsolete machinery, a textile company upgrades to the automated looms. The old manual looms cannot be sold or reused since they provide no economic benefit. They must be de-recognized and written off. A manufacturing plant suffers a fire and a certain machines are completely destroyed. Even if insurance claims are pending, the damaged machine should be de-recognized immediately. Regulatory ban. A chemical company owns equipment for producing banned substances. Since the asset cannot legally be used or sold, it has no future economic benefit. There might be technological obsolescence. A telecom company's 3G equipment becomes redundant after the shift to 5G. So if it cannot be repurposed or sold, it should be de-recognized. What are the practical challenges in de-recognition? Timing of de-recognition is a challenge. So determine the exact date when the control transfer can be complex in certain cases of conditional sales or deferred delivery. Estimated the carrying amount of replaced part cannot also be a challenge which we discussed in the previous slides. And then the linked insurance claims. When an asset destroyed by fire, company often receive insurance component compensation. Accounting for impairment, derecognition, and compensation requires careful application of Ind AS 16, Ind AS 30, and Ind AS 37. So in summary, derecognition ensures that the financial statements reflect only those assets that continue to provide economic benefits. Proper accounting for disposal and replacement and related gains or losses is critical for transparency and compliance. Let's take a real life scenario that combines derecognition, impairment, and insurance compensation under Ind AS 16. The case study involves entity A, which operates 5 manufacturing units across India on 1st April 2015. A major fire broke out at one of the units. The carrying value of the fixed asset is that unit was 8 crores. The company has had insurance coverage and received a claim of 12 crores, which included 10 crores for the reconstruction of the unit and 2 crores for the loss of profits or revenue loss. The actual cost of rebuilding the unit was 11 crores. So how should this be accounted for? Ind AS 16 provides a clear guidance that the compensation from third parties for impairment or loss of PPE should be recognized in the P&L when it becomes receivable, not when the asset is rebuilt. Further, Para 66 also provides that the derecognizing of the carrying amount of destroyed asset is necessary or mandatory when the no future economic benefit exists. So in this case, we should derecognize the destroyed asset, which is the carrying amount of 8 crores, recognized as a loss from fire in profit and loss account. Recognize the insurance components of 12 crores when it is approved by the insurer. Please note that this is not netted off against the asset loss. Both are to be shown separately, and both may incur in the different periods as well. Reconstruction of the unit. 11 crore is the new cost and it should be capitalized as a new asset if it meets the recognition criteria. So the key point is 2 crore of loss of profit is revenue in nature and should be presented in P&L, and 10 crore for reconstruction is not adjusted against the cost of new asset. It is treated as compensation income. Practical challenge: sometimes insurance claim often take time to settle and companies must recognize compensation only when it becomes receivable and not on expectation. Both the loss on derecognition and the insurance compensation should be shown separately. Compensation for loss of asset and loss of profit may have different tax treatments. And if the asset is partially damaged, in that case, impairment testing under Ind AS 36 may be required before the derecognition. So in summary, this case highlights the importance of clear separation between asset derecognition, insurance compensation, and reconstruction of asset. Proper accounting ensures compliance with Ind AS, ensures compliance and provides a true and fair view of the financial impact of such events. So now let's move to an equally important aspect of accounting of PPE disclosures. While recognition and measurement tell us how to account for the assets, disclosures ensure transparency and comparability for stakeholders. Ind AS 16 requires companies to disclose measurement basis, that is whether the company has uses the cost model or revaluation model, depreciation method used for the each class of assets, useful life or depreciation rates for the each class of assets, gross carrying amount and accumulated depreciation at the beginning and at the end of the reporting period, with a reconciliation showing additions, disposals, revaluations, depreciation, impairment, and foreign exchange differences. For each class of PPE, companies must also disclose restrictions on title, contractual commitments, expenditure on assets under construction, and compensation from third parties for impaired or lost assets. In case of revaluation, the effective date of revaluation, whether the independent valuer was involved, and the revaluation surplus and restriction on its distribution should also be disclosed. For example, a company revalues its land and building. It must disclose the date of the revaluation, the increase in the value, whether the value was done by the registered valuer. This helps investor understand the basis of asset valuation. In addition to Ind AS 16, Schedule 3 of the Companies Act prescribes specific disclosures for PPE, a reconciliation of gross and net block at the start and end of the period, title deeds of immovable property not in the name of company, revaluation details, whether revaluation was done by the registered valuer, and further some disclosures for CWIP like aging schedule, details of project overdue or exceeding the original cost, and projects where activities has been suspended. For example, a 50 crore CWIP for a new plant, it must disclose how long the project has been under construction and whether it is delayed or overrun. This helps investor to assess the project execution risk. Common issues is incomplete reconciliation, non-disclosure of title deeds, CWIP aging errors, revaluation and disclosure gap. So the disclosures provide stakeholders with confidence and the company's assets base is accurately represented, that there is no hidden risk related to ownership, valuation or project delays. In summary, again, they are very critical part of good corporate governance. They ensures transparency and helps investor to make the informed decisions and protect companies from regulatory penalties. So in the coming slide, there is a disclosure recorded related to the PPE for the specific company, where we are just trying to show that how the recognition, how the disclosures have been made. So the measurement base has been disclosed, initial recognition policy has been disclosed, the policy on component accounting has been disclosed, derecognition policy has been disclosed, and further the treatment of subsequent costs has been disclosed in the financial statements. Further, on the depreciation front, depreciation method, useful life, and the depreciation in case of component accounting has been disclosed. Again, the useful life of the building on the and leasehold land, basis of determination of useful life has been disclosed. Frequency of the review of factors affecting depreciation on the estimates has also been disclosed. This is the RECO of gross value from the beginning till the end of the period, breakdown between additions, disposals and other adjustments. Again, for the CWIP, aging has been disclosed for the projects in progress, and no project overdue exceeding the original cost has been disclosed as the part of the financial statement disclosures. So thank you all for your attention throughout the session on the accounting. Let me quickly summarize the points we discussed today: recognition, initial measurement, subsequent measurement, depreciation and component accounting, derecognition and disclosure. So in essence, proper accounting for PP is not about compliance. It is about presenting a true and fair view of entity's financial position. Applying these principles consistently enhanced reliability and decision making for all the stakeholders. Thank you once again for your participation. Let's now move on to the Q&A session.
Thank you very much, Mr. So let us see some of the questions which came on our chat from the participants. So first question is, can expenditure on regulatory approvals like environmental clearance or land or change of land use, can it be capitalized as part of PP cost?
So this is what we have already covered in our discussion as well. If the cost incurred on the regulatory approvals or change of land, and we are certain that the probability future economic benefit will flow to the entity, in such cases the expenditure can be capitalized as a part of PPE.
Okay, thank you. One more interesting question is, if company builds public infrastructure like road, bridge, railway, siding, etc., and for its project, but it doesn't own them, so can this cost be capitalized?
Yes. So the similar case study we have covered in our discussion. Although the company do not have the ownership rights, but these costs are essential to bring or to construct and operate the facility. Hence, these are the directly attributable cost, and should be considered as a part of property, plant and equipment.
Okay, thank you. One question is regarding the small items. So, for example, while generating the assets, some small items like tools, molds, small equipments, their expenditure is also incurred. So, whether they should be capitalized or expensed out.
So basically, India's 16 requires the capitalization criteria. So I mean, it is based on the criteria. If the future economic benefits are probable and cost can be measured,
Right.
then can be capitalized. Further, the standard does not prescribe a unit of measure for recognition.
Yes.
In their judgment is required, and in addition to that, there are materiality principles around the financial reporting framework which are applicable in case. So companies, there is no threshold given in the standard or the financial reporting framework, but yes, companies may set a threshold limit for capitalization based on materiality. Further, there is also a guidance note I can recall on the schedule 3, which says that the asset below threshold can be fully depreciated in the year of acquisition, provided that the aggregate impact of all such assets should not be material.
Right. So the materiality is one of the key concept to be also together kept in mind.
For sure. Materiality is the key concept, and materiality is very subjective, and it depends upon whether information omission or misstatement could influence the decision of investors. So materiality again depends on size and circumstances of the organization.
Correct. Thank you. So one question is on the land and building are acquired together, but the building is unusable. So and will be demolished. So building is unusable and it will be demolished. So the entire cost to be treated as a land or how we can do it?
So if the building is if the land and building is acquired together and the building is unusable and will be demolished, so it shows that the management's intent is not to acquire land and building both. They only intended to acquire the land. So in such cases, the entire price should be treated as the cost of land, and the demolition cost and site preparation cost, whatever incurred in the demolition of building, should also be capitalized as a part of new building. But the purchase price should be capitalized as a cost of land.
Okay, good. That's very interesting to understand that this will be capitalized as a new cost, new building cost for the
demolition cost should be capitalized as a new building.
etc. Yes. Thank you. The next question is a spare part with a useful life of 5 years is used in the machine that has a remaining useful life of 15 years. Should the spare part be depreciated over its own useful life of 5 years or the remaining useful life of machine of 15 years? So which
So basically a spare part is very specific to the property, plant and equipment. However, the useful life of spare part is 5 years.
Right.
So again, the depreciation begins if the spare part is qualified the criteria of PPE. The depreciation should begin when the spare part is actually available for use, even though whether it has been put to use or not. So in such cases, the useful life of spare part is 5 years and should be depreciated over the period of 5 years, beginning from the date when the spare part was actually available to use.
Got it. Thank you. The next question is, can general consultation cost, such as expenses of obtaining the environmental clearance that are not directly attributable to any specific asset, but affect multiple assets? So whether that kind of expenditure should be capitalized? If so, under which asset they will be recognized?
See, it depends upon the facts and cases of circumstances. If the environmental clearances has been taken and it is not directly attributable, in such cases it should not be capitalized. However, there may be certain instances where instead of taking the environmental clearance for one piece of PPE or one piece of land, and suppose I have a different classes of land in the same area, and I go for the environmental clearance for whole 5 assets at one time.
Correct.
And those expenses are directly attributable. So again, it depends upon the facts. But if it is directly attributable, only then it should be capitalized basis and allocated basis the value of the asset. But in cases where these are not allocated or these are not directly attributable, they should not be capitalized as a part of asset.
Thank you. One more question I will have on the direct attributable cost only relating to this para 17. Let us say we have added the direct attributable expense of, let's say, salary or gratuity expense or ESOP cost, whatever be this staff cost as a. Now, let's say if these expenses are no longer payable in the next year on account of resignation of employee or whatever be the scenario, and let's say there is a reversal required. So whether that reversal will also pass through the PPE or that reversal will pass through the P&L account, given that original addition was there in the PPE.
So, this is a very unique circumstances where, company has incurred an expenditure and capitalized it as a part of PPE in the past. And now going forward, the company realizes that this expense or provisions are no more required.
Right.
So in such cases, basically this standard requires us to do the evaluation at the time of incurrence of cost.
Okay.
So at the time of incurrence of cost, if these expenses were directly attributable to the PPE, then the reversal should not happen through adjustment to the carrying value. It should be routed from the P&L account.
Okay.
Because you need to evaluate the direct attribution or necessity of incurrence of cost at the time when the cost is actually happening and not later because of the change in circumstances.
Got it. That's really nice of you. If any member have other question, they can post on the chat. Otherwise, it was really nice and engaging discussion where you have covered almost all the aspects, and our audience have also been very kind enough to post a lot of questions. So thank you very much, first of all, to Ankit ji, you for providing these encouraging thoughts on the complex topic. And thank you to the institute team, Rahul ji, and technical support team. Thank you to our Accounting Standard Board Chairman and Vice Chairman, ICI leadership team. Thank you. Thank you to our audience, because without audience, any program is not possible. So thank you. Have a good day ahead and happy tax filing season. Thank you.
Thank you so much.
Yes, Sanket, you may end. Okay, thank you so much.